What happens when a completely routine scheduled mathematical adjustment just accidentally triggers a catastrophic algorithmic panic sell?
Oh, man, yeah.
Because today we're looking at the Karachi Stock Exchange, and we've got this really fascinating stack of data in front of us.
We do.
It's a comprehensive technical analysis summary, and it covers the broader KSE-100 index, along with a series of very specific 4-hour charts for some key equities.
Right. And, when you first look at this kind of market data, it can feel like staring at a foreign language.
Oh, absolutely. It's overwhelming.
Yeah, you're hit with this wall of just dense terminology. You've got relative strength index, stochastic oscillators, ascending support channels.
Right. Horizontal resistance ceilings.
Exactly. It is very easy to feel completely overwhelmed by just the sheer volume of the metrics.
Which is exactly why our mission for this deep dive is to decode that language.
Yes.
We want to extract the hidden narratives of market health and human psychology that are, buried beneath all those decimal points.
Because there is a story there.
There is. And the goal is to give you a shortcut to understanding how to read a market's pulse. Because once you understand the mechanics behind these terms, those seemingly random charts become this very clear, very human map of fear and greed.
They really do. It's psychology on a page.
Yeah. Okay, let's unpack this. Before we zoom in on any individual stocks, we have to establish the broader environment they're living in. Yeah. And that means looking at the primary index, the KSE-100.
Because you have to know the weather before you can understand why everyone is, carrying an umbrella.
It's a great way to put it.
The KSE-100 sets the macroeconomic tone for the entire exchange.
So looking at the macro view, the KSE-100 is currently sitting at roughly 177,370. It's up about 400 points today, which...
It's modest.
Yeah, very modest gain, maybe 0.23%. But the context around that number is wild.
Oh, yeah, the range.
The 52-week range is massive. It's been as low as roughly 144,000 and pushed way up past 191,000.
That's a huge swing.
It is. And there's a specific timeline discrepancy here that really stands out to me.
Okay.
The index has a one-year change of positive 19%.
Right.
But a year-to-date change of less than 2%. It's like 1.91%.
Yeah, that discrepancy, it tells a very specific story about market fatigue.
How so?
Well, a 19% one-year return means that late last year, the market had this massive, aggressive upward thrust, right?
It was flying.
Yeah, but that year-to-date figure of just under 2%, that reveals that since January 1st, the market has essentially just been grinding sideways.
Oh, I see.
Yeah, all that explosive upward momentum simply evaporated. And the index has been fighting this grueling battle just to tread water this entire year.
So it's just stuck in the mud.
Exactly.
And the 4-hour charts visualize that struggle perfectly. Like in early August, the index peaked in this 182,000 to 183,000 range.
Right.
But now it's entered what the source calls a corrective phase, trying to stabilize in the 176,500 zone.
Yeah, it's pulling back.
The analogy that comes to mind for me is a marathon runner.
Okay, I like that.
Like back in early August, this runner hit a steep incline and just sprinted with everything they had to reach that 183,000 peak.
Right.
But nobody can sprint a marathon forever,
Oh, you'd collapse.
Muscles fail, lungs burn. So now our runner has kind of pulled over onto this plateau, this 176,500 zone, bending over, hands on their knees, just trying to catch their breath.
And, well, a healthy market actually requires these breathing periods.
Really?
Yeah, it breathes in during a rally, right, inhaling capital, and it exhales during a correction, shaking out the weak hands.
Oh, okay, so right now the Karachi market is exhaling.
Exactly, it's exhaling. But the critical mechanism to watch is whether this exhale turns into a total collapse.
Which brings me to a very specific number on this chart. The daily low support is listed at exactly 176,577.
Right, we're hovering right around there now.
Yeah, so is that specific number a solid concrete floor where a runner can safely sit down, or is it actually the edge of a cliff?
See, that is the pivotal question for the entire macro environment.
Right.
Because a sustained hold above that 176,577 daily low is absolutely crucial to prevent a much deeper downside correction.
Why that exact number, then?
Well, support levels are not just arbitrary math drawn on a chart. They're literal psychological battlegrounds.
Battlegrounds.
Yeah, that specific level is where institutional buyers previously looked at the price, decided the asset was undervalued, and deployed massive amounts of capital to buy it.
Oh, I get it. They built a floor out of their own money.
Exactly.
So if the price drops below that number, it means those deep-pocketed buyers
Mm-hmm.
are either out of money or they're just out of faith.
It's precisely the latter. If the index falls below that support line, the entire psychological architecture of the market shifts.
Wow.
It signals that the buyers have exhausted their willingness to defend the asset, and the sellers have completely seized control.
So the floor breaks.
If that floor breaks, our marathon runner isn't just catching their breath anymore. They are stumbling backward down the side of the mountain. Yeah, so holding that floor is everything for maintaining the broader market's confidence.
Okay, so that's our macro plateau. We have a broader market resting precariously on the edge. Now let's take that concept and apply it to some individual equities.
Let's do it.
We have two major infrastructure stocks here, DG Con Cement or DGKC and Lucky Cement, LECK, that perfectly mirror this resting on the edge behavior.
They really do. These are heavyweights.
But they're throwing off some deeply contradictory technical signals.
Yeah, these are two heavyweights in the cement sector, like I said, and their charts right now are incredibly tense.
Let's focus on DGKC first. The current price is right around 221.
Okay.
It has immediate resistance, so a ceiling pressing down on it, at roughly 222.
Right.
But its support, the floor beneath it, is an ascending trend line sitting at 220. It's hovering barely a point above that floor.
It is trading in an incredibly compressed, suffocating space right now.
Here's where it gets really interesting. The technical indicators for DGKC are completely at odds with each other.
Yeah, they are.
The RSI, the Relative Strength Index, is sitting at about 63, which the source categorizes as healthy.
Mm-hmm.
But the stochastic RSI is sitting at a maxed out 100, which is screaming overbought territory.
Screaming. Yes.
So I have to push back on the logic here. How can a stock's momentum be both perfectly healthy and totally maxed out at the exact same time?
It's a great question.
To me, it sounds like you're driving a car down the highway and you listen to the engine, that's the RSI, and the engine sounds perfectly smooth.
Right, cruising.
Yeah, cruising along at 65 miles an hour. But then you look down at the dashboard, and the engine temperature gauge, the stochastic RSI, is flashing bright red, warning you the engine block is melting. How do those two realities coexist?
What's fascinating here is the mathematical difference between those two indicators and why they paint this contradictory picture. So the standard RSI, the engine sounding smooth in your analogy, is just looking at the speed and magnitude of recent price changes.
Over a certain time.
Yeah, usually over a 14-day period. So a score of 63 out of 100 means the stock has steady, positive momentum. It isn't wildly overextended yet, it's just cruising nicely.
Okay, so that makes sense.
But the issue is that standard RSI can sometimes be too slow to pick up on sudden, dangerous shifts in momentum.
So why do we need the second gauge? Like, why is the temperature light flashing?
Because the stochastic RSI is a derivative of a derivative.
What does that mean?
It doesn't look directly at the stock's price at all. It actually measures the RSI itself.
Wait, really?
Yeah, it looks at where the current RSI is relative to its own recent highs and lows. And because of that, it is hypersensitive.
Oh, I see.
When the stochastic hits 100, it's screaming, hey! The momentum hasn't just been positive. The buyers have had their foot completely pinned to the floorboard without a single microsecond of relief.
Wow.
It's telling you that the rate of acceleration is entirely one-sided. And in any market, a one-sided thrust is bound to exhaust itself violently.
So even though the overall speed of the car is safe, the fact that they're just revving the engine higher and higher means they're about to run out of gas.
Exactly. And that makes its position on the chart incredibly dangerous.
Right, because of that floor.
DGKC is trading just 1 point above its ascending trendline support. And Lucky Cement, LUCK, is in the exact same spot.
Hovering right there.
Resting squarely on its active ascending trendline around 442.
And an ascending trend line means the floor isn't flat, right? It's slowly rising over time, tilting upward.
Right, which means the pressure is constantly increasing.
So the buyers have to keep stepping up.
Buyers have to constantly step in at higher and higher prices just to keep the stock from falling through the floor.
That sounds exhausting.
It is. When stocks hover this closely to a rising floor, while simultaneously flashing these maxed out overheated indicators, the tension is immense.
Yeah, it sounds like a powder keg.
If the buyers hesitate for a single afternoon, that floor shatters. And when an ascending trend line breaks, it usually results in a violent downward shift in trend.
It's like defending a fortress, but the walls keep getting heavier every day.
That is perfectly said.
So the cement stocks are hovering right over their support floors, staring down into the abyss. But as we transition over to the energy and telecom sectors, the pressure completely flips.
Oh, totally different story here.
Yeah, these stocks aren't threatening to fall through the floor. They're violently banging their heads against immediate resistance ceilings.
The psychological posture of the market is completely inverted here.
Take PTC, Pakistan Telecommunication. The price is hovering right at 70.20. And the immediate horizontal resistance is at 70.4.
Which is microscopic.
Right, that is a microscopic cap. Pakistan State Oil, PSO, is dealing with the exact same restriction. Price is near 373, and immediate resistance is pressing down tight at 374.
Yeah, no room to breathe.
I look at this extreme proximity, and I don't see a car on a highway anymore. I see a pressure cooker. You know, the heat is on, the steam is building, and the price is just rattling into that incredibly tight lid.
Right.
When a stock is squeezed this tightly against a ceiling, does it usually mean the pressure cooker is about to explode upward? Or is it just going to exhaust itself and collapse?
Well, if we connect this to the bigger picture, we have to look at the institutional architecture creating that pressure cooker.
Okay, what do you mean by architecture?
Well, PTC doesn't just have a ceiling at 70.40. It actually exists within a much broader, clearly defined trading channel.
A channel?
Yeah. The upper boundary of that channel is way up at 78 to 80.
Oh, wow, that's high.
And the lower boundary floor is all the way down at 68.
So the stock actually has this massive box it lives in, but right now it's just trapped right in the middle.
Right. And channels are fundamentally driven by algorithmic and institutional trading. Bots, exactly. Large funds program their bots to buy the asset when it nears the bottom of the channel, so around 68.
Right.
And then they sell it when it nears the top. This creates a self-fulfilling prophecy of bouncing prices.
Just pings back and forth.
But right now, PTC is wedged at 70.20 against this micro-resistance ceiling of 70.40.
So it's stuck on a mini ceiling inside the big box.
Exactly. It is testing the conviction of the market.
Testing how much steam is actually in the cooker.
Exactly the right way to think about it. If it can generate enough buying volume to break that immediate 70.4 euro lid, the pressure is released.
And then what?
Then there's a lot of empty, breathable air for the price to run all the way up to that 78 boundary.
So breaking the mini ceiling is the trigger.
It triggers buy signals for trend traders, yeah. But if it fails to break that lid,
What happens?
the traders who bought down at 68 will look at that failure, decide the momentum is dead, and immediately take their profits.
Oh, so they just bail.
They bail. That creates sudden selling pressure, and the price will likely ping-pong right back down to test the 68 support floor.
Man, it is a high-stakes game of chicken between buyers and sellers.
It really is.
And it's all dictated by these invisible lines in the sand.
Right, lines drawn by algorithms.
So we've seen stocks desperately defending their floors, and we've seen stocks trapped in pressure cookers trying to break the ceiling.
Yeah.
Now we have to look at the outliers.
Yes. The breakdown phase.
The charts where the tension finally snapped.
The breakdown phase is always the most revealing part of technical analysis.
You look at TPL Corp, that's ticker TPL, and TPL Properties, TPLP, and they're dealing with these incredibly tight, suffocating margins, just pennies between their floors and ceilings.
Very tight.
But the chart that completely steals the show here is GTYR, Gandhara Tire, and Rubber.
It is the defining technical anomaly in this entire data set.
It's wild. The current price is sitting exactly at 28.74, and its immediate horizontal support level is
Wait for it.
28.74.
Yeah.
It is sitting mathematically perfectly on the floor.
Perfectly flat.
But the resistance above it is way up at 32.65.
Which is a huge gap.
Huge. And the data notes that this 32.65 level is a broken channel line.
Right.
So what does this all mean? Like, the context provided is that there was a sharp breakdown from its ascending channel following a recent dividend X date.
Marked with a D on the chart.
Right, the D.
And that single event caused immense cascading technical damage.
Well, I need you to explain the mechanics of that. Because I see an X dividend date, and my understanding is that this is a purely mechanical event.
It is.
When a company pays a dividend, that cash leaves the company's balance sheet, and the stock price automatically drops by that exact amount to reflect the lower valuation.
That's right.
It's a scheduled, predictable math equation. So why would a predictable mechanical price adjustment trigger a massive technical breakdown and market panic?
This raises an important question about the intersection of corporate actions and algorithmic trading.
Okay.
Because you are absolutely correct with the mechanics. A dividend X-date price drop is guaranteed. It is scheduled months in advance.
Right. Everyone knows it's coming.
No human trader is surprised by it. However, the algorithms that drive market momentum do not read corporate memos. Oh,
They only read geometry.
So they just look at the lines on the chart.
Yes. And the context of where that mechanical drop happened is the tragedy here.
What do you mean, where was it?
Before the ex-dividend date, GTYR was already trading dangerously close to the bottom floor of its ascending channel.
It was already weak.
It was weak. So when that mechanical scheduled price drop kicked in, it didn't just lower the price, it pushed the price mathematically outside the bottom boundary of the channel.
Oh, no.
It broke the floor.
Oh, wow. So a routine corporate payout essentially acted like someone removing a load-bearing wall during a routine house renovation.
The whole thing comes down.
The structure just collapsed.
That is the perfect way to visualize it. Once that line was breached, it triggered automated stop-loss orders from traders who were defending that floor.
Because their bots saw the floor break.
The algorithm saw a critical support level fail, which triggered aggressive short-selling bots.
Oh, man.
The selling created more selling. It morphed from a mechanical adjustment into a catastrophic algorithmic panic. It's the doom loop.
A total doom loop. And that's why the indicators reflect such extreme trauma right now. GTYR's RSI is deeply oversold at roughly 26.
And 26 is bad.
Anything under 30 implies sheer panic, where human logic has completely left the building.
Wow. And its stochastic RSI is sitting at an abysmal 2.8.
Yeah.
Out of 100.
2.8.
That's not just an overheated engine. That's an engine that has completely stalled out, frozen over, and died on the side of the road.
It is absolute technical capitulation. The spark that started the fire was a boring scheduled dividend adjustment.
Right.
But because of where the stock was positioned, the resulting blaze burned down the stock's entire trend structure.
It just obliterated it.
It went into a free fall until it finally slammed into this historical rock-bottom horizontal support at exactly 28.74.
And that's where we are today.
That floor is the only thing keeping it alive right now.
That is just terrifying to think about.
Yeah.
How a predictable corporate action can just completely shatter a chart's technical geometry because an algorithm can't tell the difference between a dividend payout and a mass sell-off.
It's blind. It just sees the break.
It really brings it all back to why we're doing this deep dive in the first place. You know, if you're listening to this, you might have initially wondered why you should care about these dense support and resistance numbers or oscillators or 4-hour charts.
Yeah, it sounds like math homework at first.
Exactly.
But they matter because these numbers are physical, historical maps of collective human psychology interacting with machine logic.
Maps of fear and greed.
Right. Every support line is a monument to a moment in time where human greed outmatched human fear. It's where people said, this is too cheap, I must buy.
Right.
And every resistance ceiling is a monument to where fear overtook greed, where people said, this is too high, I must take my profits and run.
When you learn to read those monuments, the chaos of the market actually becomes a highly legible story.
Yeah.
It's the pulse of human emotion, graphed out in real time, dictating where capital flows. Which brings me to a final thought I want to leave you with today, building right off of that GTYR freefall we just analyzed.
Okay.
We know that GTYR's current price is sitting exactly, perfectly on a support floor at 28.74.
Right on the line.
The buyers have drawn their line in the sand there. But if you look closely at the data, the very next level of support listed below that is 25.88.
That is an incredibly massive void in the chart.
It is an almost 10% drop.
Wow.
There was absolutely zero listed safety net between 28.74 and 25.88.
Yeah.
No historical buyers, no institutional defense lines, nothing.
Just thin air.
So as you go about your day, I want you to mull this over.
Yeah.
What happens to the collective psychology of a market when that 28.74 floor suddenly becomes a trapdoor and there is absolutely nothing beneath you but empty space?